Brian bought a 3,200 square foot house in a new development outside Atlanta. 4 bedrooms, 3.5 baths, bonus room, formal dining room, 2-car garage, vaulted ceilings. The kind of place that photographs well and impresses relatives during holidays. The purchase price was $475,000. His mortgage payment is $2,800 per month. When he signed the papers, he thought that was the cost of the house. It wasn't even close. Within the first year, the real numbers started showing up. A $430 electric bill in the summer just to cool the space, a $370 gas bill in the winter, property taxes of $6,200 per year, insurance at $2,400 annually, an HOA fee of $220 per month for amenities he rarely uses, water and trash averaging $140 per month because large houses consume more of everything. Add it all together, and Brian isn't paying $2,800 per month. He's paying closer to $4,700, over $53,000 per year just to keep the lights on and the doors closed. Brian makes $92,000 a year. After taxes, he takes home about $62,000. The house consumes nearly everything. He has about $1,300 left per month for food, gas, savings, entertainment, and life. He owns a house, but the house owns him. The biggest mistake buyers make is confusing the mortgage with the total cost of ownership. Lenders qualify you based primarily on principal and interest. They rarely emphasize the long tail of expenses tied directly to square footage. A larger house doesn't just increase the loan size, it increases every recurring cost attached to the structure. More space means more heating and cooling, more exterior walls to insure, more roof to replace, more property taxes because assessments scale with size and value. According to federal energy data, households over 3,000 square feet spend dramatically more on utilities than those under 2,000. That gap compounds every year. What looks like a manageable mortgage becomes a high-maintenance financial machine. Brian thought he was buying space. He actually bought overhead. When you double the size of a house, you rarely double your happiness, but you almost always double your operating costs. Property taxes scale with assessed value. Insurance scales with replacement cost. Maintenance scales with complexity. Larger homes often require multiple HVAC systems, bigger roofs, longer gutters, and more landscaping. There's also an unspoken cost most buyers ignore: furnishing. Brian moved from a 900 square foot apartment into a 3,200 square foot house. His furniture disappeared into the space. The rooms looked empty. He spent nearly $18,000 furnishing rooms he rarely uses: dining table, guest bedroom sets, decorative pieces to fill the square footage. Most of it went on credit cards. He's paying interest on furniture purchased to make the house look complete. The house didn't just demand higher utility bills, it demanded lifestyle inflation. Larger homes don't just cost more monthly, they carry larger deferred expenses. Roof replacements, HVAC systems, siding repairs, appliance upgrades, flooring replacements. When something breaks in a big house, it's bigger and more expensive to fix. Many homeowners underestimate annual maintenance by thousands. A common rule of thumb is budgeting 1% to 4% of home value per year for upkeep. On a $475,000 property, that could mean $10,000 to $19,000 annually in long-term maintenance expectations. Brian isn't setting aside that kind of money. He can't. The monthly operating costs already absorb nearly all his take-home pay. So when something major fails, the only option will be more debt. Here's where the real damage happens. If Brian had bought a $275,000 smaller home instead, his total annual cost might have been around $30,000 instead of $53,000. That's roughly a $23,000 difference per year. Invested annually at a reasonable long-term return, $23,000 compounds aggressively. Over 5 years, it becomes 6 figures. Over 10, it can become hundreds of thousands. Brian traded future investment growth for unused square footage. From the outside, he looks successful. Inside his bank account, there is no margin. Equity growth in the early years of a mortgage is slow. Most payments go towards interest. Meanwhile, the opportunity cost of not investing that cash flow compounds invisibly. He swapped liquid wealth for illiquid space. There's a psychological layer to this trap. Larger homes signal achievement. They communicate stability and status. Pulling into a big driveway feels like progress. But research consistently shows that beyond the reasonable comfort threshold, additional space doesn't significantly increase happiness. What does increase is financial stress tied to maintaining it. Brian uses 3 rooms daily. The rest sit empty, heated, cooled, insured, and taxed. He is paying for 3,200 square feet, but living in maybe 1,000. The house delivers pride during occasional visits from guests. It delivers bills every single month. Oversized developments often create quiet competition. When everyone around you buys large, newly constructed homes, smaller options feel like downgrades. But high-income zip codes with large new builds often show elevated debt-to-income ratios. Many residents are stretched thin maintaining appearances. Builders profit. Banks profit. Homeowners absorb the long-term cost. The forever home becomes a financial cage disguised as permanence. Financial freedom depends on surplus. Surplus creates options. Options create security. When housing absorbs 60 to 80% of your take-home pay after operating costs, surplus disappears. Without surplus, you cannot invest meaningfully. You cannot pivot careers. You cannot weather emergencies comfortably. The house becomes a fixed obligation that dictates your employment, your stress levels, and your retirement timeline. Brian doesn't feel wealthy. He feels trapped. Downsizing feels like failure. Selling the dream home feels like admitting you miscalculated. But staying in a home that prevents wealth accumulation is not perseverance, it's denial. If downsizing frees $20,000 or more per year in cash flow, the math is clear. Transaction costs hurt once. Overspending hurts indefinitely. Smaller homes often bring lower utility costs, fewer maintenance surprises, and less pressure to furnish unused space. Freedom often looks smaller than ego expects. If you're shopping for a home, calculate total ownership costs before buying. Add mortgage, utilities, property tax, insurance, HOA fees, maintenance expectations, and furnishing. If the combined number exceeds 30% of your gross income, you are stretching beyond stability. Buy less house than you qualify for. Lenders approve based on risk tolerance, not lifestyle sustainability. If you already own an oversized home and feel financially suffocated, run the numbers honestly. Compare annual costs with a smaller alternative. Quantify the difference over 5 and 10 years. And ignore social pressure. Neighbors don't fund your retirement. A forever home sounds romantic, stable, final. But if it locks up your income, limits your savings, and restricts your flexibility, it isn't forever. It's a prison with granite countertops. Brian thought square footage equaled security. Instead, it erased his margin. The house that was supposed to symbolize success quietly consumed his financial future. Bigger isn't better, it's heavier. And the true cost of square footage isn't measured in feet, it's measured in lost options.